Hey there.
Imagine buying insurance, paying just a few thousand shillings, and when disaster strikes, your car is fixed, your house is rebuilt, or your hospital bill is fully covered. Sounds too good to be true, right? Well, that's the power of insurance. But how does it actually work? Today, we break it all down in a way that finally makes sense. No jargon, no confusion, just clarity. We will be learning how insurance works. So, grab a seat, stay tuned, and let's demystify the world of insurance together. Welcome to Insurance World TV, your trusted channel where we break down everything you need to know about insurance in a simple, practical, and even fun way. Insurance. It's the annoying necessity that we all pay for to make sure we don't end up in massive amounts of debt. If our house burns down, if we crash our car, or if something tragic happens, insurance helps us maintain peace of mind. Knowing that even if something bad does happen, someone else is going to pay for what it costs to fix it. Though to an untrained eye, this can be a little perplexing. If you pay 20,000 Kenya shillings a year for homeowners insurance, also known as domestic package insurance, and after only 6 months your home burns down, the insurance company will pay you an amount enough to buy you a similar house, likely in the region of millions of Kenya shillings. But you would have only given them 20,000 shillings. Why would they do that? That's the power of insurance. What is insurance? The basic concept of insurance is that the insurance company, also known as the insurer, offers a guarantee for a certain risk that may or may not occur. Then another party, the insured, pays the insurer in exchange for protection against that risk. When a bunch of people do the same thing for the same risk, eventually the insurer is getting a lot of income. This is called risk pooling. But the probability of that risk happening is spread out among a bunch of people and stays about the same. Insurance companies make money by figuring out how much money they need to bring in to turn a profit on a given risk with a given probability. That calculation then influences how much each of the insured pays each month. In general, it's simple math. But in reality, insurance companies use highly complex models for all of this. Not every insurance company offers the same insurance. Most insurance companies specialize in their own kind of insurance. This is because each company has to develop a complex model to ensure that they can make money, ensuring a profit. If you estimated that 1 in 100 houses burn down each year, but it was actually 5 in 100, you'd be losing money pretty fast. You'd probably charge too little for everyone's insurance and then end up on the hook for those 4 extra houses. Types of insurance. There are many types of insurance policies, from auto to health to life to homeowners. Most people in the world have these core insurance policies, some of which are legally required to be held, like auto insurance. You might be wondering though, why wouldn't I just want to save my money each month? Just hold on to it in a bank account. Then, if nothing bad ever happens, you'll have a lot more money. Well, while that may be true, it makes you the one exposed to the risk. If you put away 20,000 a month for a year to save on home insurance, you'll have an extra 240,000 shillings at the end of the year. However, if your house burns down the next year, well, you're going to be out of a house, probably worth millions of shillings, and that is what it's going to take to fix the house or buy a new house. Now, the 240,000 shillings you saved last year is just a fraction of what you need to fix the situation. A pretty bad deal. Is that a risk you're willing to take? Chances are it isn't. That's why getting insurance is generally a good thing. It takes all of the risk, anxiety, and financial burden off of you and puts it onto a much larger company that can afford it. When you understand insurance as just a way of paying a company to assume your risk, you can start understanding that insurance could, in theory, be offered on virtually anything. Anything? Are you worried that while you're boiling a delicious maize and beans on your Jiko, a rogue fire spark will fly out, land on your nylon curtain, and set off a chain reaction that burns down your entire kitchen stocked with unga, cooking oil, and Blue Band? Well, that's oddly specific. But someone could probably insure you for that exact thing. Likewise, maybe you're really attractive and worried that if you fall one time, you're going to hit your face, stop being attractive, and be depressed because no one will like you anymore. Well, somebody could probably insure you against that too. This isn't too far off reality either. Celebrities will often have parts of their body insured because their image is a source of their income. Reinsurance. There's a few more pieces to the puzzle here, though, and we should talk about reinsurance and insurance claims. When an insurance company wants to buy insurance on their own insurance policies, they buy something called reinsurance. That's not a joke. Say an insurance company realizes they're overexposed to home fire insurance, and a hot summer is coming up. They could take out reinsurance policies on their insurance policies to protect them from high losses in case all the houses they insure just burst into flames. Because global warming and whatnot. Then all the risk is on the reinsurance company. This is a necessary thing. Think about it. If an insurance company insured everyone in Florida's cars, but then a hurricane came through and destroyed all the cars, that insurance company may owe more in payouts than they have. And once they run out of money, well, then no one gets paid for their destroyed car like they thought they would. Reinsurance is necessary and important to ensure that insurance companies remain profitable and solvent, so they can pay out insured claims when needed. Fraud. In terms of claims, insurance companies don't just automatically pay out. If you have car insurance and you show them a crashed car, the insurance company will investigate to make sure that you didn't intentionally crash your car to get the payout. If they find out that you did do that, well, that's called fraud, and you can go to jail. Faking insurance claims actually does happen quite frequently. People see it as a way to either get a big cash windfall if they're in hard times or get out of a car or house payment they can't afford. However, car insurance companies employ top-of-the-line investigators to make sure they don't make faulty payouts. So now you can likely see, insurance is big business. And if you have the right models, assume the right kinds of risk, and have good investigators to make sure you're not defrauded, well, then you can make a lot of money. Conversely, if you buy insurance and something bad happens, it can save you a lot of money. In most cases, insurance is a winning formula for all parties involved. It helps consumers be less worried about bad events, and it makes companies a lot of money. And that's basically how insurance works. See? It is not that complex, was it? Hopefully you have learned something and we appreciate your company throughout the video. But hey, we've got more videos you could probably click on right here that might be interesting. Subscribe and click on the notification bell to stay in touch. Enjoy your day. Thanks for learning about insurance. We'll see you next time.
Bye.